All right, good afternoon once again. You're welcome. Let's continue with where we stopped last time. Now we're talking about taxation of small businesses. Taxation of small businesses. So I'll be sharing my slides now. So just a moment so that we can all start again. So I believe you can see my screen. Let me push it to the presentation mode. Okay, just a second. Okay, so here we are. Even right now, you're welcome once again. We're still talking about tax 418. Okay, so taxation of small businesses. Now, that I title as taxation of sole proprietorship business. Okay, so that's where we starting from even right now. Okay, so let's begin. Okay, a sole proprietorship is a commercial enterprise that is privately owned by one or more persons. That talks about a sole proprietorship, small businesses, unincorporated businesses. Okay, it has unlimited liability because it is not formally incorporated as a company. And so that means that the profit belongs to the owner. The loss, if any, also belongs to the owner. If there's any debt whatsoever, then the owner is responsible for its payment. So those are the one of the two features of a sole proprietorship. So now let's look at the legal framework. The profit of an enterprise being an unincorporated entity is taxable in the hands of the owner. Okay, so in the hand of the owner. So basically, that's what it entails. So because it's unincorporated, then every profit is taxable in the hand of the owner. So taxation of sole proprietors is covered by Personal Income Tax Act, PITA, Personal Income Tax Act, and so this falls under the purview of Nigeria's personal income tax, system. Now, the current one is 2004 as amended in 2011. Okay, 2004. Okay, and then amended in 2011. Okay, so that's the legal framework. Let's look at the taxable incomes. What are the taxable incomes when it comes to taxing um, unincorporated enterprises? We have gains, we have profit, dividends, and interest or rent, annual charge or annuity, gains or profit, including any premiums arising from the right granted to any person for the use or occupation of any property, emolument or remuneration from employment from either the public or private sectors. Okay, so remuneration covers salaries, wages, fees, allowances, including compensations, commission, bonuses, premiums, benefits, and other perquisites allowed or given or granted by any person to an employee. Any balancing charge arising where a business person dispose of an asset used for trade or business uh, by carried on by it at a profit, then any profit or gain or other payments accruing to an individual not falling within the items listed above. The idea is every income is taxable as much as possible, although there will be some clarification later on. But the ordinary understanding that you should have is that all these gains, all these items listed here, according to Peter 2011, they are taxable. Okay, now let's look at this. In order to determine profit, accounting profit, what do? You deduct expenses from your income and then you arrive at your profit. So income, expenses, minus expenses will give you your so profit. You can see income is bigger than the expenses and you have profit. Now the other way around is to say, okay, where expenses may be much more than the amount of expenses is much more than that of the income. That's a negative loss. I mean, that's a negative position. At the end of the day, that's a loss. So let's look at income. Now, income is possible for us to divide income into two or classify income into two. You have earned income and then you have unearned income. Earned income basically means income derived from a trade, business, profession, vocation, or employment carried out, by a person, carried on by a person, or pension derived by him or her in respect of any previous employment. So that's earned income. So whatever income that you exert your power, you exert your physical energy to earn becomes earned income. On the other hand, we have unearned. Unearned means these are incomes that you earn that physically you are not involved in earning. Okay, now we can talk about passive income. For example, investment income. Having invested your money, you go to bed and your investment keeps generating money. That's an earned income. You could not rent, for example, when you build a house, all right, you are not working physically to earn rent from it. You've done that before. So you begin to earn your rent, dividends, royalties, discount, and all of that. So where this income, basically at times they will withholding tax from it. Okay, mostly subject to withholding tax. So once the withholding tax is deducted, then it becomes what is called franked investment, income. Let's look at expenses. Now, remember we talked about income. So income to be classified into two, earned and unearned. Then we also let's look at expenses now. We have two types, classifications as well, allowable expenses and disallowable expenses. So as the name implies, it means that for the purpose of tax, okay, there are expenses that are, there are expenses that are allowable and there are expenses that are disallowable. So it's not every expense that is allowed for the purpose of tax. Exactly. It's not every expense that's allowed for the purpose of determining what is payable as tax at the end of the. So you must be able to differentiate, between the two. Now let's move ahead so that I can have a better understanding of what we're talking about. So expenses are recurrent expenditure incurred in order to generate the profit for an entity. Recurrent, so it keeps on coming. The current expenditure incurred in order to generate the profit for an entity. These expenses, deductions, are grouped as allowable or non-allowable deductions. All right, they are grouped as, they are either, like I was explaining before, allowable or non-allowable. Okay, so if it is allowable, then tax authorities will allow it for you to deduct. If it's not disallowed, if it's disallowable, then that means that tax authority will not accept those expenses as tax deductible. So we have a lot of them, but of course, one thing you have to understand is the principle of what's called principle of REN, WREN. It must follow WREN principle. So for a particular expense to be allowed, must follow this principle. Okay, this means that the allowable expenses must be wholly, reasonable, exclusively, and necessarily incurred during that period. Okay, that's REN. Now let's look at the understanding of REN here. Okay, wholly means that the entire amount in question must be borne for the purpose of earning the income. Exclusively, the expenses incurred must be exclusive for the generation of the income. Necessarily, the income cannot be derived without incurring that expense. It's necessarily incurred. Reasonably, the expenses should be comparative with the other with the prior year expenses or with the income generated. Industry standard, regulatory approval, and income. Let me take that again. So reasonably, what we're just trying to explain is that it must be justified. Okay, you can't say that you earn 50,000 naira, for example, and then you now incur a cost of 49,000 or expense for 49,000 in order for it to generate income of 50. So there must be a kind of standard that I'm going to use. So it must be reasonably incurred so that everybody who is listening or seeing it will say, okay, this person is justified. Okay, the expense is worth it at the end of the day. So that's what it means, that reasonability, test that it must pass, there. Okay, so let's look at some allowable expenses. Interest on loan. So when you borrow money for the purpose of funding or financing your business, then it's allowed. Not private, interest, not private loan. Rent and rates. So rent and rates incurred on land occupied for the purpose of the business. It's also allowed. Repairs and maintenance of any asset employed in the business. Provision of data that of a specific nature. Mind that, not general, but specific. If it's general, then it's not allowed. Bad debt written off. That's if that is written off, then it's also allowed. Contribution to a pension to a pension scheme approved by JTB It's also allowed. Legal expenses that are limited to general legal administrative services, retainership, renewal, these are, allowed. Okay, you can see the breakdown there. They are, allowed. Any other expense proved by the board to have been incurred for the purpose of the business, individual business is also, allowed. Let's look at some disallowable expenses. So deductions not allowed. You can see that in section 21 of FITA 2004. FITA provides that the following items shall not be allowed as deduction: private or personal expenses of the owners. You can't bring that one in. For example, I pay school fees for my son and daughter, and I have a business. I can't use that school fees as part of to offset, I can't use it as an expense of the business. Not, it's your own personal expense. Okay, capital expenditure or withdrawal that's of capital nature. So you can't also use that one. Any loss or expenses recoverable under insurance or contract of indemnity cannot also be allowed. Rent and cost of repairs to any premise or part of business not incurred for the purpose of producing the income is not also allowed. Taxes, generally, you don't allow tax. Any form of tax is not allowed. Okay. Now, any unapproved payment to pension scheme, provident savings, or widows society, orphanages, none of these ones will be allowed. Okay, so none of the taxes will be allowed as an expense. Deductions allowed still. Depreciation of any asset. Instead of depreciation, you only allow what's called capital allowance. Any sum reversed or reserved out of profit, except where there is an express permission under section 20 of FITA. Okay, any amount, any sum reserved. Now, for we talk about reserves, usually when you have money and you don't use it. Okay, after deducting your expenses, you have your net profit. At the end of the day, you have excess. Whatever it is, maybe you appropriate it to a particular reserve account or that is not also allowed as taken as a liable expense. Okay, um, any payment of management fees except with the approval of the commission. Legal expense shall include. So any other, now you talked about legal expense earlier on, but then this legal expense is different. So when you're defending your traffic offense committed by a staff or committed by you or yourself as the owner of the business is not also allowed. Some donations are allowed under CETA. Yes, that's correct. Fines and penalties, they are not also, allowed. So this is the personal income tax table, effective from 14th of June 2011. Okay, so that means that what this means is that profit is not taxed, unlike um, the corporate world. All right, limited liability companies. For unincorporated companies, like we said such the profit of such business are taxed in the hands of the owner. So it means that it is not a lump sum, it's not a particular percentage, it's a graduated figure. Okay, so we have these rates given, okay, in 2021 as the rate to now be that you'll be using from 2020 um 2011. Okay, so hitherto we had the different rates, but now from June 2011, this is what has been recommended, has been approved that we use. Give them first 300,000 will suffer 7%. Second 300,000 will suffer 11%. Next 500,000 will suffer 15%, 19, and like that, and like that, and like that. So it means that it is a graduated figure, okay? A graduated amount. That's what you have, okay, at the end of the day, whenever you are computing the tax to be paid. All right. So let's look at adjusted profit. Adjusted profit is computed after adding back disallowed expenses and deducting allowable expenses and incomes exempted. So that is, how to calculate your adjusted profit. So it means that once you have your net profit, the profit of the business, you have your net profit. Okay. And before you arrive at your net profit, remember you must have deducted, you must have earned your income, revenue, put everything together, both end and on end, put everything together. All right. Some could come from employment, some from trade or business. Okay. Now you put you have that one on one side. They have our expenses on one side. But this one is not saying that at the end of the day, when you arrive at your net profit, and in order for you to calculate your adjusted profit, okay, you need to add back your disallowed expenses. All the expenses that have been disallowed, you need to add them back. Okay, you need to add them back. Then allowable items not so treated will also be deducted. Income exempted will also be deducted. And so you now have your adjusted, our accessible profit. That's the way to calculate it. It's as simple as that. Okay. You need to deduct all of this thing because if you're eventually you should take them to the tax office, take your compensation tax office, and they discover you'll probably pay more in terms of extra. Okay, so let's go to compensation of taxable income, loss relief and treatment. Now, a trade or business loss occurs when its allowable operating expenses exceed its total income. So when your allowable expense, okay, when it's more than your income, what happens? You are trading at a loss. You are doing certain things as a loss. So it means that your trade does not your business, suffer a loss. A company that makes a loss from its trade or business is entitled to relieve such by carrying it forward to offset it against the accessible profit of the subsequent assessment years, commencing from the year following that in which the loss occurs. So it means that if you lost your core in your business in 2025, for example, you have the you have the you have the power to carry it forward, to be relieving it from the subsequent years profit. Loss relief procedure is similar to that of corporate income tax, okay, except for the current year's loss. It is important to state that losses can be carried forward indefinitely. Okay, now so we're still talking about loss relief. So these are the procedures for granting loss, okay, by the government. So please take note of this. It's important that you take note. So the relief is in respect of the loss brought forward on the preceding year of assessment. The relief is automatically granted, hence no need for claiming it in writing, as is this case under current year's loss relief. Okay, these are the provisions, these are the conditions, okay, that will apply when it comes to loss relief. What is important is that, yes, you can carry it forward, okay, all right, then you can only carry it forward against the same business line, against the same business. So income from the same business is what's going to use to offset it. So if you are buying and selling a merchandising company, or you're buying and selling, stuffs, if you happen to lose anything, will also be brought back and adjusted against a profit. All right. But if you do the particular line of business and you have another one, you can't adjust the loss of company of business A against the profit of business B. It must be the same line of business. Okay. Let's look at capital allowance. What is capital allowance? Capital allowance can be defined as a relief that is claimable by a taxpayer who incurs qualified capital expenditure during a basis period in respect of assets in use for the purpose of trade, business, and business or business at the end of the basis period. So now we talk about depreciation, we talk about capital allowance. At the end of, you know, at the end of each year, usually you charge depreciation, but you can't take depreciation to the taxman. All right. So a taxman will deduct what they call capital allowance. They've allowed you, because you're using that asset, they've allowed you, and then to deduct the um, capital allowance. All right. So qualified capital expenditure means the expenditure incurred during the basis period of a company in the acquisition of a particular item of non-current asset related to non-current asset. For example, plant and machinery, buildings, motor vehicles, furniture and fittings are not incidental expenses incurred in bringing the asset to a usable, position. Okay, that's the definition of capital, qualified capital, expenditure. So you must take note of that definition. Qualified capital expenditure means the expenditure incurred during the basis period of a company of a particular items of non-asset current and non-current asset. So that's the definition. A capital allowance can also be defined as allowance granted a taxpayer in lieu of depreciation charge. I mentioned that before, even um, in the earlier lecture. Now, conditions for granting capital allowances. What are the conditions? Number one, capital expenditure must have been incurred in the basis period. So you must have a particular period, okay, a particular window. If it's not incurred then you cannot change it. All right. The asset must be in use in the at the end of the basis period. Okay. It must be in use at the end of basis period. Now, the asset must have been used for the deployment of for development and the enhancement of the trade or business of the company. And the company must be the owner of the asset. Okay. Application for certificate of acceptance must be made within the Federal Ministry of Industry, where total value of additions, plant, where total value of additions to property, plant, and equipment exceeds 500,000 in the given year. That's a lot. But in most cases, practically, this is not being followed. Okay, this condition is not being followed. Once you buy, you have evidence that you have purchased motor vehicle, plant and machinery, generator, furniture and fittings. Once I have evidence, you can just go ahead and apply the capital allowance. Okay. Let's talk about balancing allowance and charge. Now, in a particular year, it's possible for the owner of a particular asset or the asset of the company to say, let me dispose it. Excuse me, let me sell it. Now, in the process of selling it, now regularly, when you sell an asset that you have depreciated before in a regular business or regular accounting, whatever, you calculate you adjust your figures in order to arrive at either a profit at a loss, or I mean whether a profit, rather a profit for that sale of asset, a gain, let me not call it profit, gain from the sale of asset, or a loss from the sale of asset. Okay, gain from the disposal of the asset, rather, and then loss from disposal of such an asset. So now you now begin to talk about balancing charge and balancing adjustment. Okay, so balancing charge and balancing allowance. So this supposed to be arises upon the disposal of a qualifying capital expenditure in a year of assessment. The disposal may result in either balancing or balancing result may please pardon me may result in either a balancing allowance or balancing um, charge. Okay, please be mindful of this. Balancing charge, see type of balancing charge. Okay, let me just quickly adjust it. Balancing charge. All right, balancing charge. Yeah, so done. So the result in either balancing allowance or balancing charge. Now, balancing allowance happens when the tax written down value, there's something called tax written down value. That is when by the time you deduct the cost of the asset, you deduct from it the accumulated um, um, capital allowance. You remove it from the cost. Okay, you now have what is called tax written down value. So by the time you dispose of the asset, you deduct your tax written down value from the cost, from the amount that you realize from it. So when you, let's say you have 50,000 naira worth of a particular asset, all right, you have a tax return value of 35,000. So the difference is 15. Okay. But now, if you now want to sell the asset, you're going to be using the tax return value as a basis for you to determine whether you sell it, whether it is sold at a profit or sold at a what? At a loss. So balancing charge happens when it is like sold at a loss. When it's sold at a loss. Then balancing charge takes place when it is sold at a profit. Do you get it now? When it's sold as a profit, then you have what's called balancing charge. When it's sold at a loss, then it is called balancing allowance. Okay, so let's look at this format. Balancing profits arrive at by adding the balancing charge to the adjusted profit while subtracting the capital allowance and loss, while subtracting the capital allowance and loss relief. So the value derived from the computation of standard tax profit at this point, relevant tax rate can now be applied. So here you have this is the format. So you have adjusted profit brought down. Okay. Don't forget we have calculated the adjusted profit before. Add balancing charge. Okay. Add your balancing charge. That's the profit realized. As a matter of gain realized when at the point of disposal. Then you also deduct your capital allowances and then loss. We talked about loss earlier as well. Okay. Computation of gross income. So gross income, what does it mean? We finish with the expenses, expense side of it, and then we're moving to the income side of it. All right. Gross income means income from all sources, less non-taxable income of which no further tax is payable. Okay, tax exempt items listed in the paragraph 2 of the sixth schedule. Okay, you can just lay your hands on it and read it. Okay, so what are the tax exempt items? So we have some items that are tax exempt. Okay, they are exempted from, so they are not borne out of expenses of the company, but rather these are normal things that people do in order for them to um, actually, what do I call it now? I'm trying to look for a right one, maybe not an accounting term, in order for them to survive. Okay, in order for them to take care of themselves and take care of the future. Okay, so we have tax exempt items. For example, National Housing Fund contribution. So it's expected, it's allowed by law that every individual that's working, whether in the private or public sector, contribute a particular percentage into the National Housing Fund contribution. The idea is by the time you finish all of this, then once accumulated over a period of time, you can collect the money and then go and use to buy or fund your business, your the construction of your house. Okay, for a private sector person, is usually 2.5% of his basic monthly salary. Rather for public, that's the rate. That's what they deduct from the salary. But today, private sector's employees are now excluded from this for the compulsory compliance. So if you choose to do, you're doing it on your own. All right. National Health Insurance Scheme. This National Health Insurance Scheme was set up by the National Health Insurance Act. So LFN 2004. So in the public sector, this is the rate. Then the private sector, this is also the rate. So meaning that you have an insurance scheme that you contribute to. There's an insurance scheme that every employer is supposed to contribute to on behalf of their, staff. Okay, so every month they dump money from the staff salary. They also add their own percentage and they remit it to the the insurance company that is supervising overseeing your insurance scheme. So the third one is life assurance premium. This is a deduction of the amount of money, okay, used for premium. Premium now talks about life assurance that you pay for. So that's life assurance premium. The last one is national pension scheme. Okay, we must have been hearing about pension, all this while. National pension scheme is also part of it. Okay, so you deduct 8% from the employee's remuneration, whereas 50% is contributed to it by the National Population Commission. Okay, those are the tax exempt matters. So chargeable income is arrived at after deducting the consolidated relief allowance. So you calculate all your everything plus or minus income exempt and income allowed, plus or minus income expenses allowed and expenses not allowed. You have everything stated there. So when it comes to this one, this is statutory allowed. There shall be allowed a consolidated relief allowance of 200,000, subject to a minimum of a minimum so it's a minimum of 1%, of gross income, whichever is higher. So it's sort a minimum of 1% of gross income. So if your gross income, 1% of it is higher than 200,000, there is 200,000 naira. So when that whichever is higher, plus 2% of gross income in the taxable, plus 2% of gross income, and the balance shall be taxable in accordance with the income table in the sixth schedule to the art. So let's look at some of them. Let's see this forward. Okay. Second self, chargeable income, tax liability, and other funds to arrive. So you have taxation. Okay. For now, in this case, this account or this sample has given us a loss. This one is a profit position. So net profit, then you add back all the disallowables, deduct the they'll add back the taxable income not reported. It's possible for some business owners not to actually report some things, but the cost of filing is cost of preparing this, get to know about it, and so it must be added. So frank investment income has to be deducted, allowable expenses not reported also has to be deducted, and then you arrive at what's called adjusted and assessed, but we did that before. Then when you now have losses, you now have losses brought forward, relieved. So this is the amount of money that you have been able to cater for in this particular year. So you deduct um, your loss that has been relieved, that you want to relieve, you deduct from here, and then you push it to the extreme end here. Then you have a loss carried, forward, and then you have balancing charge. Okay, balance charge will be added, and then you have more figure here, and then you have capital allowance. So this capital allowance is first time. Let's assume that this company has been in business for long. So this capital allowance brought forward, capital allowance for the year, balancing charge, balancing allowance, we said that before. So balancing allowance is also taken into consideration there. Then the amount relieved at the end of the day. So there will be a portion that will be relieved at the end of the day. So that's what we have. Um, for this particular um, class. I think there's a particular portion that I've not also added here, and that has to do with what's what I call tax exempt figures. By the time you relieve this, you arrive at this shouldn't be the. Let me see. Okay, you have this there. So you have, excuse me, I must have jumped some things along the line. I guess I didn't really explain this then. Just a minute. We talk about capital allowance, yes. Talk about taxable income. All right, so taxable capital allowance. So we talked about, we didn't, okay, I must have jumped, skip this. Let me just bring it back. So we have conditions for granting capital allowances. Capital expenditure must have been incurred in the basis period. The assets must be in use, okay, at the end of the basis period. At the end of the basis period, the asset must have been used for the development and enhancement of trade or business of the company. The company must be the bona fide owner of the asset. Application must be you know, yes, I covered this. Then, okay, balancing chart, yes, also covered. Taxable income. I think this is also covered. So you have taxable profit. It's arrived after deducting the balancing charge. Okay, I didn't talk about this. So taxable profit is arrived at after adding the balancing charge to the adjusted profit while subtracting, if any, capital allowance and loss relief. Okay, the value derived from this computation is the taxable profit. All right, so that's what you get by the time you deduct this one. That's what it arrives at the end of the day using the format that we have below. Adjusted profit brought down, balancing chart. Let's and then that one will be added. Then I talked about gross income, the meaning of gross income. Okay, gross income means all sources less taxable income, income on which no further tax is payable, tax exempt items listed in paragraph 2, and then all allowable business expenses and capital allowances, have been also been removed. So mention the tax exempt items earlier. Okay, national insurance scheme, life assurance, national pension scheme. Okay, this is also very, very important. Now we talk about pension, we also have to deduct it from the, and then we have chargeable incomes arrive at after deducting consolidated relief allowance, and then you have this figure as your consolidated relief allowance. I think I mentioned this earlier on. I thought I did talk about this, earlier. So this is the format. Okay, this is the format of the computation you have to do. Gross income, chargeable income, and then tax liability. Is after this is not allowing me to push it further, but let me just show it here. After you must have remove this is the format. Okay, your net profit or loss, add back the salables, deduct this, then your loss is relieved, proportion, and then losses carried forward. Balancing charge, a capital allowance profit, capital allowance for the year, capital balancing allowance, okay, relieved. So this is a question that I relieved. So this is where I went back the other time. Now you have your tax exempt items, you have national housing, fund contribution, national pension contribution, national health insurance scheme, life assurance, then your gross income minus the consolidated relief allowance, then you have your chargeable income. This amount that you're going to apply your risk to for you to arrive at your the tax payable. Thank you. That will bring us to the end of this particular lecture. So thank you for being part. I'm going to send to you a question that I want to just try your hands to calculate, try your hand on, and then let us see what we got. We'll meet physically and then to see how we can solve the question, later on. So thank you for being part of the class. All right, so see you in class someday. I'm still going to do something that will bring about, I'm going to talk more about loss relief. I'm going to talk more about capital, allowance, much more later on. Okay, so that'll bring us to the end of the class. Thank you.